Welcome back to Report of Silver, your trusted source for daily gold and silver market analysis, where we break down the latest developments shaping the future of precious metals. Today's topic is one of the biggest silver stories we've seen in years, and it could change everything. New legislation may finally be targeting one of the biggest problems in the silver market: manipulation. For decades, investors have believed that silver prices were being artificially suppressed by major financial institutions, especially large bullion banks operating through the futures market. Many people talked about it. Many analysts warned about it, but very few in government were willing to openly acknowledge it. That may be changing right now.
A new bill called the Silver Act, officially known as the System Integrity Through License Vault Expansion and Resilience Act, or H.R. 8007, has entered the spotlight, and it is directly challenging the structure that has allowed this market to be controlled for years. What makes this so important is not just the bill itself, it's who is talking about it. During a recent House Agriculture Committee oversight hearing, lawmakers openly discussed the risks created by how precious metals are stored and delivered in the United States. For the first time on record, members of Congress questioned whether the current structure of silver and gold delivery creates market vulnerability, national security risk, and systemic weakness. That is a massive development. Why? Because once lawmakers begin questioning the infrastructure behind the market, they are no longer just discussing price, they are discussing power. And that changes the conversation completely. So what exactly is the issue? Right now, nearly all approved precious metals depositories used for COMEX gold and silver deliveries are located within roughly 150 miles of New York City. Think about that for a moment. The largest precious metals futures market in the world depends on physical vaults concentrated in one small geographic area. That means if there is a major disruption, whether it's a cyber attack, natural disaster, infrastructure failure, or even a national security event, the entire delivery system could be impacted. Lawmakers are now openly asking, why is this allowed? Why are these vaults not spread throughout the country? Why is so much control centralized in one place? Congressman Mark Harris raised exactly that concern during the hearing. He pointed out that New York has already experienced major disruptions in the past, from the 9/11 attacks to Hurricane Sandy, and argued that concentrating such critical financial infrastructure in one location creates unnecessary risk. He described it as a national security issue. And that phrase matters because once something becomes classified as a national security concern, government action can move much faster. That is why many analysts believe this bill has real momentum. Now let's talk about what the Silver Act actually does. The bill would encourage the approval of more precious metals depositories across the United States. It would not force specific vaults to open, but it would remove the old restrictions that favor New York and create a more competitive system. That means more geographic diversity, more competition, and potentially much less centralized control. On the surface, this sounds like simple modernization, but underneath, it may do something much bigger. It may weaken the grip that major Wall Street banks have had on silver pricing. Why does that matter? Because control over storage often means control over delivery, and control over delivery can influence futures markets. If only a handful of institutions manage most of the approved vault space, they have tremendous influence over how silver moves through the system. Critics have argued for years that this concentration makes price suppression easier. If the market becomes decentralized, that influence could weaken, and that is why this bill has the silver community paying very close attention. This is not just another government proposal. This is a direct challenge to the current system. For years, silver investors have waited for someone in Washington to openly acknowledge that something might be wrong with the structure of this market. Now it is happening. The question is no longer whether the issue exists. The question is what happens next. Now that we understand what the Silver Act is trying to do, we need to ask the bigger question. Why does this matter so much? Why are silver investors so excited about what looks like a simple change in vault locations? The answer is because this is not really about vaults. It is about control. For decades, the silver market has been dominated by a small group of powerful institutions, especially large bullion banks operating through the futures market. These banks do not need to own huge amounts of physical silver to influence price. They influence price through paper contracts, massive amounts of paper contracts. This is one of the biggest misunderstandings in the silver market. Most people assume silver prices are determined by physical supply and demand. That sounds logical. If silver is scarce, prices should rise. If silver is abundant, prices should fall. But that is not how the current system works. Most silver pricing is determined on the futures market, especially through COMEX, where traders buy and sell paper contracts representing silver, not actual bars. In many cases, those contracts are never settled with real silver. They are rolled over or settled in cash. That creates a major problem. It allows the market to be flooded with paper silver. Imagine if there were 250 paper claims for every 1 real ounce of silver. That is the concern many analysts have raised for years. It creates the appearance of huge supply, which naturally suppresses price. In simple terms, it makes silver look less scarce than it really is. That helps keep prices artificially low. Now think about how the vault system fits into this. If almost all approved delivery vaults are concentrated in one area, around New York City, then the same institutions operating there have enormous influence over physical settlement. They control where silver is stored. They control how it moves. They control delivery logistics. That creates what many call a centralized bottleneck. And when one small group controls the bottleneck, they can influence the system. This is why the Silver Act could matter so much. If new vaults are approved across the country, whether in Texas, Florida, Utah, or elsewhere, it breaks that centralized structure. Suddenly, silver delivery becomes more decentralized. More competition enters the market. More transparency becomes possible. And most importantly, the traditional power held by a few major institutions begins to weaken. That is exactly why this legislation has people talking. Lawmakers themselves are now questioning the system. During the recent hearing, Congressman Mark Harris asked why, in a modern economy, all these precious metals depositories remain clustered in one geographic location. He asked why the market still depends on a structure designed decades ago. That is a fair question, and one many silver investors have been asking for years. Then came the response from Commodity Futures Trading Commission Chairman Michael Selig. He acknowledged that concentration risk is something regulators should examine. That may sound small, but it is a major shift. For years, concerns about silver manipulation were often dismissed as conspiracy theories. Now the regulator itself is openly discussing structural risk in the market. That is new, and it is powerful. Another major issue is competition. Right now, storage fees at existing exchange-approved facilities are often near the maximum allowed. Why? Because limited competition allows it. If more vaults open in more locations, storage costs could fall, market access could improve, smaller participants could enter the system more easily. That would create a healthier market overall. But again, the bigger story is not storage fees. The bigger story is what happens when the physical silver market becomes harder to control. If physical silver starts moving more freely and more investors begin demanding real delivery instead of paper settlement, the paper market starts to feel pressure. That is exactly what happened historically during major silver squeezes. When physical demand rises faster than the system can handle, cracks begin to show. And many investors believe we may already be seeing those cracks today. That brings us to the next part of this story, because recent events at COMEX have made people even more suspicious. Delivery demand is rising, system glitches have happened, and questions about whether enough silver really exists are getting louder. Now let's move into what may be the most important part of this entire story. Physical silver demand. Because while most people are focused on the daily price of silver, serious investors are watching something else: delivery. And right now, delivery activity is sending a very interesting signal. To understand why this matters, you first need to understand how the silver futures market works. On paper, it looks simple. Investors buy and sell silver contracts through COMEX. Each contract represents a certain amount of silver, usually 5,000 ounces. In theory, when a contract expires, the buyer can request physical delivery of that silver. That means actual bars, actual metal, physically transferred. But here's the reality. Most contracts never go to delivery. Historically, traders simply roll over their contracts into the next month or settle in cash. That allows the system to function smoothly because only a small percentage of participants ever ask for real silver. The system depends on that behavior. It assumes most people do not want the metal. But what happens when that changes? That is where things get interesting. Over the past several years, we have seen a major increase in physical demand. More investors, institutions, and even governments are choosing to take possession of real precious metals instead of relying on paper claims. That trend matters because it puts pressure on the delivery system, and pressure reveals weakness. Many silver analysts believe the current system works only because most people never demand what they technically own. Think of it like a bank run. A bank works fine as long as only a few customers withdraw cash at a time. But if everyone shows up at once asking for their money, the system breaks. The same principle applies here. That is why many investors call COMEX leveraged. There may be dozens or even hundreds of paper claims attached to the same ounce of physical silver. As long as nobody asks for delivery, that structure survives. But if enough people ask, that is the problem. This is why the story of the Hunt brothers is still so important today. Back in 1980, they attempted to buy enormous amounts of silver, both physical and futures contracts. As they accumulated metal, silver prices exploded toward $50 an ounce. Why? Because physical demand was overwhelming the system. Eventually, rules were changed. Trading restrictions were introduced. and the market was forced lower. That event showed something very important. When physical demand becomes too strong, the system reacts. Now fast forward to today. Many investors believe we may be entering a similar environment. Not identical, but similar in principle. Retail demand has grown. Institutional demand has grown. Central banks around the world are buying gold aggressively, which often increases broader precious metals interest. Industrial demand for silver continues rising due to electronics, solar panels, medical technology, and electric vehicles. And supply is not growing fast enough. That means physical silver is becoming more valuable, even if the paper price does not show it yet. This is why many experienced investors say, ignore the price. Watch the metal. They are watching vault withdrawals. They are watching delivery requests. They are watching inventory reports, because those numbers reveal what price often hides. And this is exactly why the Silver Act matters so much. If the current system is already under pressure, then decentralizing vault storage adds another layer of transparency. It makes the movement of physical silver harder to hide. It makes regional concentration less effective. It creates more independent storage locations, and that can expose whether enough real metal actually exists. That is why some believe this bill is more dangerous to bullion banks than it first appears. It is not just changing vault locations. It is challenging the infrastructure that supports the paper market. And once infrastructure changes, everything can change. That brings us to the final piece of this puzzle, why all of this may represent a much bigger shift in the silver market. Because if regulation, physical demand, and investor awareness all rise at the same time, the silver market could look very different in the years ahead. At this point, the big question becomes obvious. What happens if all of these trends continue at the same time? What happens if physical silver demand keeps rising, if lawmakers begin restructuring the market, and if investors become more aware of how the system actually works? The answer is simple. The silver market could change dramatically. And when markets change structurally, prices often follow. For decades, silver has behaved differently than most people expected. Even during times of strong inflation, rising industrial demand, and growing investor interest, the price has often remained surprisingly low. That has frustrated silver investors for years. Many people looked at silver's fundamentals and thought this should already be much higher. And based purely on supply and demand, many analysts would agree. Think about silver's role in today's world. It is not just a precious metal. It is also one of the most important industrial metals on the planet. Silver is used in solar panels, electric vehicles, medical equipment, military technology, semiconductors, batteries, and advanced electronics. It is the most electrically conductive metal. It is the most thermally conductive metal. It reflects light better than any other metal. There is no substitute for many of its applications. That makes silver unique. Gold is mostly monetary. Silver is both monetary and industrial. Now add another reality. Silver supply is tight. Most silver is not mined directly. Around 70% comes as a byproduct from mining other metals like copper, lead, and zinc. That means silver production depends heavily on those other industries. If copper production slows, silver supply often slows too. That creates a natural supply bottleneck. At the same time, industrial demand keeps growing. That is not a sustainable balance forever. Eventually, the market has to respond. This is why many investors believe silver is deeply undervalued. Not because of hype, but because the fundamentals support that view. Now let's connect that to what is happening politically. The Silver Act is not just about vault locations. It signals something bigger: awareness. For the first time, lawmakers are publicly questioning whether the current precious metal system creates systemic risk. They are openly discussing concentration problems. They are openly asking whether the market is structured properly. That alone changes the conversation. Markets often move in stages. First, almost nobody notices the problem. Then a small group talks about it. Then institutions begin discussing it. Then regulators start paying attention. That is when change becomes possible. Silver may be entering that phase right now. And if that happens, price discovery could look very different in the future. What is price discovery? It means the real price begins to reflect real supply and demand, not just paper trading. If physical silver becomes harder to source, if more investors demand delivery, if decentralized vaults reduce concentrated control, then the price suppression many investors talk about becomes harder to maintain. That does not mean silver jumps overnight. Markets rarely work that way. But it does mean the foundation could shift. And when foundations shift, long-term trends can reverse quickly. That is why so many serious silver investors are not focused on daily price swings. They are focused on positioning. They are asking one question: do I own enough physical silver before the market changes? Because if a major revaluation happens, it will not come with a warning. It never does. Most people will react after prices move. Smart investors prepare before that happens. And that may be the biggest lesson from everything we've discussed so far. This is not just about a bill in Congress. It is not just about COMEX. It is not just about vault locations. It is about whether the silver market is finally approaching a turning point, and if it is, the next phase could surprise a lot of people. Now let's bring everything together and talk about what this means for you as a silver investor, because this is where the story becomes very important. For years, many people in the precious metals community have believed that the silver market was manipulated. They believed large bullion banks and major financial institutions were using paper contracts to control the price of silver and keep it artificially low. But the problem was always the same. There was no public admission from lawmakers. There was no serious political effort to address it. That is what makes this moment different. For the first time, we are seeing lawmakers openly discussing structural weaknesses inside the precious metal system. They are openly questioning why so much control is concentrated in one place. They are openly asking whether this creates national security risks. That is not a small development. That is a major shift. Think about what the Silver Act is really doing. On the surface, it looks simple. It says approved silver and gold depositories should not all be concentrated around New York City. It encourages geographic expansion. It promotes competition. It lowers barriers for new vault operators. But underneath that, it challenges the very foundation of how the current system operates. Right now, a small group controls the storage, the delivery, and much of the pricing power. If that system becomes more decentralized, that control weakens. And when control weakens, price discovery becomes more honest. That means silver may finally be allowed to trade closer to its true value. That is why many investors are excited. They understand this is not just about storage locations. It is about transparency. It is about accountability. It is about breaking a system that many believe has unfairly suppressed precious metals for decades. If this bill moves forward, it could create pressure on the institutions that have benefited from the current setup. Those institutions will not like that. Change will not happen easily. But even the fact that this conversation is happening publicly is a sign that something is changing. At the same time, demand for physical silver continues to rise. That is another critical point. Investors are not just buying paper silver anymore. More people want real coins, real bars, and real ownership. They want assets they can hold in their hands. Why? Because trust in the financial system is weakening. Inflation remains a concern. Debt levels continue rising. Geopolitical tensions are increasing. Central banks around the world are buying gold at record levels. All of these factors are pushing people toward hard assets. Silver is especially interesting because it is not only a monetary metal, it is also an industrial metal. It is used in solar panels, electric vehicles, medical technology, electronics, and defense systems. That means silver has two engines driving demand: investment demand and industrial demand. At the same time, supply growth remains limited. New mines take years to develop. Production costs continue rising. And if the market really is tighter than many people think, any major shift could create serious upward pressure on price. This is why legislation like the Silver Act matters so much. It may look technical, but it could have very real consequences. If it helps expose weaknesses in the current system, investors may gain more confidence in physical ownership. That alone could increase demand even more. And if enough people start demanding delivery instead of paper settlement, pressure on the system grows. So what should investors do? First, stay informed. Laws like this can seem boring at first, but they often signal deeper change. Second, understand the difference between paper silver and physical silver. They are not the same. One is a promise, the other is ownership. Third, think long-term. Silver has always been volatile in the short term, but its long-term value story remains strong. At Report of Silver, this is what we watch closely. Not just price moves, but the structural changes happening behind the scenes. Because sometimes the biggest stories are not found in the daily chart. They are found in policy changes, legal reforms, and shifts in market power. And right now, that shift may already be starting. The question is no longer whether people are paying attention. The question is whether this is the beginning of a new era for silver. And if it is, those who prepared early may benefit the most.